Okay, well, let's get in our experts on and try and figure out what this means for the global markets. Michael Preiss, he's Executive Director, Client Investments at Taurus Wealth Advisors, joins us on the show from our Singapore studios. In a bit, we'll of course get in James Glassman, Managing Director and Head of Economics at Commercial Banking at JPMorgan Chase on the phone line from New York as well. But Michael, let me start off with you. What does this mean for world markets? Chinese markets, of course, have rallied. This is a bit of a booster to the economy, or at least not a negative for the economy. But what would this mean for markets at large, which are anyways rallying on the back of a dovish Fed?
Yeah, look, I think markets have been a little bit oversold. So what we are now seeing is a relief rally. The more important question is, because if you think about it, 2017 was very good for risk assets. 2018, so far, most markets around the world have been down with the exception of the US. In my opinion, what we could see is basically selling into strength instead of buying the dip. So again, I still hold the view that potentially in 2019 we see a sort of more global slowdown in economic growth that over time might actually feed into asset prices. So I expect more and more people to consider these bounces, these rallies, to sell into instead of buying them.
Glassman, as I said, also with us. James, good evening and thanks for staying up till late. What does this mean for the world markets? The same question actually that I asked Michael Preiss. What does this mean for world markets, which are anyways rallying on the back of a dovish Fed?
Yeah, I think it's constructive. I think actually the bigger news is what everybody expected. We thought that at the G20 meeting, President Xi, President Trump would try to dial down the tariff tensions. And I think the market's reaction to this tells you this has been the main obstruction to the equity markets and the mood most of this year. So I think, frankly, I think this is constructive. I think both sides realize this is not going, it was not going in the right direction. And I don't think there's a time frame here. I mean, they say 90 days, but I think as long as there's some effort to try to move forward so that we don't have to keep hearing about more tariff threats, this is a constructive development for the global economy.
So Michael Preiss makes an important point, James, and which is that 2019 has demons of its own. I'm using the terms demons, he didn't use it, but I'm just saying there are growth issues at hand for world markets at large, which is some distance out. In the near term, after the bit of a rally that we've seen for world markets at large and the US markets in particular last week, do you reckon that we can actually build on to the strength because of what's happened at G20, or will it be priced in a day's move at best?
A lot of it is priced in. I think even before the G20 meeting, people realized that this was not helpful, and we thought there's a pretty good idea that they were going to try to find some way to dial down the tension. But I think we could build more on this because, frankly, the global outlook is quite positive. Yes, growth is going to slow down because in the U.S., the stimulus that we've had a year ago, it's really pumped things up in 2018. But I think the U.S. economy is really got very low unemployment. So a slowdown would be very constructive. And, in fact, we're not seeing the inflation threat that a lot of people are worried about. And I think that's why the Federal Reserve has taken a little more relaxed attitude about things. Where the closer we get to that ideal zone that they think, somewhere in the 2.5% to 3.5% range, the Fed is going to be more cautious, and I think that's been helpful. And frankly, we don't need the Fed or central banks to tell us they're going to be cautious when there is no inflation threats, and I think that's the key. So I don't worry much about a slowdown in 2019 because I think the world economy, the developed economies have done a good job largely recovering from the recessions. There's still more work to do, particularly in Europe. But I think this is really kind of a constructive environment. The inflation outlook is good. The financial health, the health of the financial system looks quite good, as the Fed chairman talked about last week. And those are two positive things to be constructive about for global markets, I think.
Michael Preiss, comment on that. If indeed a slowdown comes about, we'll figure it out. The point being, in the near term, the negatives, I'm looking at a market like India, for example, the negatives, which is higher crude prices, slightly more than expected hawkish Fed, as well as an imminent slowdown. All of these are out of the window right now, right? Because if indeed the trade war we have a truce and maybe some more truce is likely, then the global growth may not be as bad as otherwise would have been. Crude prices have come off and the Fed looks a lot more dovish than otherwise.
Yeah, look, I mean, whether the Fed is really dovish needs to be seen, but I think what's very important is to understand that after many years of quantitative easing, we're now having an environment of quantitative tightening. So QT, I think in January, also the European Central Bank will actually net scale down asset purchases. So again, also in the US, we might have an interest rate hike on December the 20th. So I think liquidity is still tightening, and over time, the biggest driver for asset prices is liquidity more than earnings. So liquidity is tightening, and that's why I think we also see more volatility. But longer term, again, as we've seen this year, markets potentially have more room to fall because of this tightening global liquidity. And that's also why I think emerging markets were a big underperformer this year, because of this tightening global liquidity. So if the ECB also starts to tighten in earnest, or basically tighten that liquidity, reduce that liquidity, I think we see more headwinds going into 2019. I think, again, many mainstream banks are still too optimistic about the outlook for 2019, in my view.
Okay, Michael Preiss, just one quick answer on India as well. We've come off quite a bit, but crude too has, and that's the big bugbear, which is not a risk right now. Any thoughts on India?
Yes. Yeah, look, I mean, India, I think, like emerging markets, increasingly at a level where it's prudent to potentially dabble in and buy some more, because I think it's also down to the dollar. If the dollar starts to weaken in 2019, I think emerging markets, and India in particular, can potentially rebound more. So yes, we are actually quite constructive on emerging markets, and especially India at this level.
That's great. James Glassman, Michael Preiss, gentlemen, both of you, thank you so much for taking the time out and being with us today on Bloomberg Quint India. Really appreciate your time.